Hi and welcome to Train2INVEST YouTube channel. In this channel we provide information for you to make your own judgments on a number of topics, and the idea being that we challenge the normal state of things and bring new concepts and principles and ideas for individuals and families to rethink how they should plan their lives. So today's topic, somewhat challenging to some people, it would be. For example, when we talk about this topic, some get excited and say, yes, this is what I needed, this is what I wanted to understand, this is the concepts that I would like to apply, while others roll up their eyes and say, hey, this is crazy, I don't understand this. This is beyond my pay scale. I don't have the knowledge or the ability to comprehend the terminology that's used in this topic. While others say, no, I'm not interested, I don't want to know, I don't care, I'm just going to leave it in the hands of experts. Okay? That's nothing wrong with that. There's nothing wrong with that at all. What we want you to show, or to at least take a few minutes today and listen to us and say, okay, before I make a judgment call, I would like to really at least have an overview of what this topic is all about. Here there's the topic that we talk about, wealth management. Now, as soon as you hear the word wealth management, a lot of people say, man, this is not something that I want to do. But unfortunately, this is the main topic that you should be talking with your family, discussing the future of your ability to bring forth wealth to your entire family. So we begin by answering the question, what is wealth? Unfortunately, most individuals and families have no idea how wealth is created or even what wealth is. They think that wealth is all just money, dollars and cents, and that's not true. Wealth isn't about money alone. It's about people. It's about relationships. It's about values. It's about doing well by doing good, and certainly about family. Wealth is a gift that needs to be nurtured, safeguarded, and shared productively for the benefit of the family and others. Each family and each individual has their own values and unique circumstances relating to managing their own wealth. It's important to understand that as a family, you ought to leave an inheritance to your children and your children's children. That is a very important concept that you should think about. All right, when we talk about wealth management, very often people don't understand the forms of capital. We have three forms of basic areas that we need to consider. When we talk about financial capital, yes, everybody understands. They look at a house, they look at security, look at cash, they can tangible, it's tangible, right? But they don't understand about human capital. Human capital is the members of your family. Why are you creating wealth? That's the human capital. Now, intellectual capital is the knowledge from the extended family that you may have. Okay, we'll come to that in greater detail at a later time. But this are the three principles, at least three forms of capital that we want you to know, or at least to think about. All right, what about the existing investments that you have? Most families already have some form of savings, usually RRSPs and TFSAs. If you have been building on that as part of your strategy and not tax strategy, so that you don't pay high taxes on your earnings, that you create RRSPs and tax-free savings accounts and RESPs for your children as well, and a number of the other options that you have. The question here, there are three questions that we need to ask about our existing investments, and what are they? The first question would be, what return are you getting on your current investments? Do you know? Second question should be, how much did you pay to get those returns? Are you paying somebody a fee? Majority of Canadians have fee-based mutual funds exposure, and then very rarely do they understand how much fees they're paying. Now, having understood what is the return less the cost, what measure are you using to compare these actual returns? So if, for example, to make it easier, let's just use round figures. Let's say you get a return of 10%. You paid 7% in terms of cost. So your net return would be 3%. So where do you compare your 3%? Is it comparable to anything? Is there a guideline to say 3% is a very good rate of return, or it's a terrible rate of return? Those are things that we need to ask ourselves. Whenever we talk about these questions, there is a mental shutdown for a lot of people. Why is that? Because they find it overwhelming. There's a mindset to say, oh, I don't have the qualifications, I don't have the ability to understand what you're talking about. What is return on investment? Some people don't even know what that means. But that's okay, there's nothing wrong with that. The question here is, how much time did you spend learning about investments? So the question then begins, who taught you about wealth management? Did you learn it from school, from your parents, from your friends, from books, seminars, university, college? No. Usually it's through osmosis, from a combination of the above. So what do you mean by osmosis? Osmosis is, for example, children are influenced by parents' view on many things, including wealth management. If the parents constantly talk about living from paycheck to paycheck, guess what? That's what the children learn. If the parents use foul language at home, guess what? That's what children learn. Children don't listen to parents, they observe them. And so this is an important thing or important knowledge that you need to pass down to your children. Unfortunately, we are stuck with tradition. There is an assumption that if you studied accounting, finance, even an MBA, you would have learned how to become wealthy. That's wrong. You would have been taught about wealth management and how to get a job and work for somebody else. And in due course, you may become wealthy, right? Over a long period of time, you may have got bonuses or things like that. And then you invested those bonuses wisely and created wealth. Unfortunately, most people learned about money and wealth management from their families. Okay, before we go on to the next point, let's think about it. If the father or the mother only knew putting money in fixed deposits and earned 0.5% a year, guess what? That's what they're going to teach their children. But the problem really is that the spouses come from different households. They have different views of money management, even if they came from the same cultural background. The reason for this is different risk profiles. What do we mean by risk profiles? All right, let me give you an example. Let's look at the husband. Let's say he comes from an entrepreneurial background, meaning that he gets involved in businesses, runs all kinds of things to generate income. His risk level is higher. He takes risks. For example, farmers take a huge risk when they put seeds in the ground and expect it to grow. Or he takes options, buys options. For him, vacation means going to Hawaii. Camping means a 5-star hotel. It's a different mindset. Whereas the wife has been grown up in a place where she was told to get a government job with a good pension. Her risk level is low. She wants to be a GIC. She just wants her money in GIC, fixed income. For her, vacation means visiting relatives. Camping means staying in a tent. As you can see from the above, they have very different risk profiles, but they were attracted enough to get married. Opposites attract, yes, that's before marriage, but after marriage they attack, particularly when it comes to money. All right, we need to talk about risk acceptance. That is, a comfortable level of risk level. That means how comfortable are you with taking risks. Usually the one with a higher risk tolerance, either the husband or wife, would have attempted to accumulate wealth through a number of methods. Okay, and we'll deal with that in a while. But before we look at the options for wealth generation, let's review the picture below. What's the question here? Which apple will you pick? A conservative person will go for this one, safer, or perceived safer. A risk taker will say, let's go for the bigger one. Let's stretch our hands out a little bit. Use a stick. Let's look at this. The wife maybe is a GIC queen and she says, okay, I'm going to just be safe and take this apple. The husband is a risk taker. He says, okay, I'll reach out and take it. But there are some gunslingers who say, back up the truck, we're going to take the tree. There are people like that. So who is right? Different strokes for different folks. And they all are right based on their risk profile. Neither decision is wrong. It depends on a person's risk tolerance, a concept that most families don't understand. A person is wired, actually created that way, and there is nothing we can do to change them. Example, if you're a morning person, you cannot change that. If you like pink, nobody can change you because that's how you're wired. Any attempt to force a behavior change, usually through manipulation, sarcasm, public humiliation, mind games, will result in frustration, bitterness, anger, distrust, eventually leading in divorce. Why? Because money is usually the ultimate security blanket that most individuals hold on to. In fact, it becomes their God as they increase in age. Have you heard how people plan for their old age? Planning is good. Being obsessed about the future is not. There is a great sense of fear, and so there is a delegation of responsibility. Many people are extremely successful in their business, in their jobs, in their professions, but when it comes to wealth management, a great sense of fear overtakes them. Two reasons. One, the spouses have no confidence in the other spouse's money management skills. Two, the objecting spouse usually has no clue what to do either. So what do? They turn over their hard-earned savings to outside experts. So how did they pick these experts, you ask? They probably listened to a good sales pitch, looked at the man's or the woman's outfits, looks expensive, comes in an expensive car or perceived expensive car. And they make their decisions not on facts, but on perception. That's the sad truth many, many people face. Trial and error methods. 90% of wealth management attempts by families are through trial and error methods. Number one is mutual funds. You never meet the person who actually does the trading for the fund, who's called the portfolio manager. All you meet are sales personnel called financial planners. This really is false advertising. But unfortunately, the financial industry and the government are hand in hand. You rub my hand, I rub your hand, that kind of thing. So they don't stop this. This is the only industry, in the financial services industry, where you lose money and you got to pay for it. Multi-level or network marketing, this usually ends up selling soap to your family members. Real estate speculation will cause a seller's market which will end up costing thousands of dollars in mortgage fees. Let me give you an example. When it's a buyer's market, the prices of houses or even buildings are very high. But then you have one guy saying, okay, I bought this house and I flipped it and I made a fortune. Great. So he goes out there, buys 10 houses, puts 10% deposit on 10 houses, and wants to flip them and make more money. But you see, there are 100 other people who think the same way. So suddenly a buyer's market becomes a seller's market. And that's where a hefty price is paid. Franchises, what you're doing is really buying an expensive job. Forex, which is foreign currency trading, and commodities, these are actually gambling, as you cannot compete with international banks. If you went to Bay Street or New York, you will see banks with 6 or 7 floors of traders trading 24 hours. The foreign exchange market is 24 hours. The commodities market is 24 hours. How could you compete? Others are black box computer programs that trade penny stocks, foreign exchange, options, futures, gambling with the help from software algorithms. This is where the software is supposed to pick certain names based on certain criteria built into the software. So tell me, how will the software pick up on Wuhan or Kabul? No, it cannot. And that's why you have day traders becoming homeless at night. Number 7, stock investing. Let's discuss this. As soon as you talk about the stock market, that's how people look at you. At the very mention, a great sense of fear overtakes them. Why? Mostly through ignorance and also false information. You never hear about people making money in the stock market. You never hear that. But you hear about somebody having lost a fortune. Here's how it goes. Most people have no idea. So the majority of people assume a couple of things. Number 1, it is a form of gambling. Number 2, it's only understood by mathematicians or extremely intelligent people. Chances are you have heard of people saying like Bob's cousin made a killing in XYZ company and now he's got another tip. Or watch out with stocks. You could lose your shirt in a number of days. So much of this misinformation is based on get-rich-quick mindset, which was particularly prevalent during the amazing dot-com market in the late 1990s. People thought that the stock market was where you had the magic answer to instant wealth with no risk. The dot-com crash provided that this is not the case. Stocks can and do create massive amounts of wealth, but they aren't without risks. The only solution to this is education. The key to protecting yourself in anything, but particularly the stock market, is to understand where you have invested your money in. Would you invest your money in Royal Bank, or would you invest it in cryptocurrency factory in, say, in northern Alberta or northern Saskatchewan? Where would you put your money? Education defeats ignorance. Look at the chart here. The economy, the left-hand side, shows that the gross domestic product in Canada was worth 1.64 trillion US dollars in 2020, according to the World Bank. And the stock market increased 15,300 points since the beginning of 1996. Okay? Don't worry about the points. I mean, it just shows you how quickly it grows. We'll talk about that later. You see, the economy grows and the market goes up. What does gross domestic product or GDP mean? It means the total value of all the finished goods and services produced within a country's borders. Right. Now, can they be accurate? Not really, but they have a pretty good idea because Stats Canada picks a lot of data, the CRA picks up a lot of information, and the government, through many surveys and reports that they receive, are able to get a guesstimate of how the GDP of a country is. So you see, as the economy grows, the stock market grows. It's not gambling. It's understanding. All right, let's look at global explosion. Here you see in 2016, China was number 1, US number 2, India number 3, Japan number 4, Germany number 5, Russia number 6, Brazil number 7, Indonesia number 8, UK number 9, France 10. 2050, you expect China to be 1, India number 2, US number 3, Indonesia number 4, Brazil number 5, 6 will be Russia, Mexico 7, Japan 8, Germany 9, and 10 UK. You see the shift that is changed? And here what we are talking about is massive growth in wealth. Do you see Canada there? No. So why are they in G7? Well, if you go into history, it was the US that pulled Canada in to be part of the G7. Okay? So as a country, we are very small. So the GDP growth is about 3.5% expected at the end of this quarter. So Canada is supposed to grow. And as Canada grows, so will its stock market. What prevents the average person from taking advantage of the stock market? Number 1 is fear. Fear of starting anything new. That is, of attempting things that society generally deemed impossible. Yeah, for 20, 30 years ago, where there was no internet, you had to pay specific fees to your broker to get you that information. But with the advent of the advent of the internet, everybody with a phone is able to get that information at the same time the brokers get it. You see, we'll talk about how to overcome that fear. Number 2, greed, instant gratification. A lot of people have tried the stock market. Why? Because Jimmy Jones gave you a tip to buy 1,000 shares at 6 cents of Mount Timbuktu's diamond mine, which was supposed to produce diamonds by the truckloads. What happened was the diamond mine was in Iraq. So they lost maybe $1,000. And so that get-rich-quick mindset stops them from actual investment. Greed stops many people. But I think the most important thing is the rapid change or rapid pace of change. Not being able to understand the technologies that change advanced every few years. That's the biggest challenge for human beings to understand. So what do I mean by that? Let's look at one rapid pace of change. Billions of people can now afford the technology. It took more than a century to populate the planet with 1 billion telephones. The second billion only took 2 years. By the end of this decade, 2 billion people will own not just phones, but phones with web browsers. That means 2 billion people will shortly have a ticket into the global economy, that they'll be able to buy and sell online using the phone. And you look at the picture below. If you ask a 20-year-old, what is this? They will have no idea. They'll have to go to the museum to see what this is. This is all that they know. What about number 2? Rewards are given to those companies that are exceedingly fast, clever, and capital efficient. This is no mystery here. Globalization is not the problem. Change, that's our challenge. In 1903, the Wright brothers made the first flight. 1969, man landed on the moon. In 66 years, one generation, what technologies took place for that to happen? To go from here to here. This was in 1969. We are in the year 2021. Do you know how much technology has changed since then? Stock trading is a gambling, is another false myth that goes around. So let me show you what actually happens. Let's say ABC company was in the oil rigging business. It has an opportunity to drill oil in the North Sea. To do so, it needs a specialized oil rig which will cost $1.5 billion to build. How will it raise its capital? Well, the actual way it goes about is it will have internal cash. So it says, let's say the ABC can generate $0.25 billion from in-house. Then it will borrow from the banks $0.25 billion. Banks will not lend $1.5 billion straight to a company because it too has rules and it is governed to protect its risk perception. So it will only lend you how much you raise. So then the ABC will go into the market, the stock market, and sell off shares to raise $1 billion. And why would somebody buy one ABC shares? All right, they will look at the prospectus and they will look and study. These are brokers who will look at these. The banks will look at these and produce prospectus reports saying that, look, we think ABC has a very good chance of hitting a gusher and it'll produce X amount of tons of oil, and so at this price you will get the shares forecasted to go from $1 to $15 in the next 5 years. So people will buy the stocks. Not only individuals, institutions too. So by that time the ABC will have raised capital of $1.5 billion to build its rigs. That's how the stock market helps to finance businesses. So you could go to our website, as you see on the right-hand side of our chart here, www.train2invest.com. You can download a free ebook called The Stock Market, The Untold Story. And here we deal with the many myths and false information that is given out to the public. And we defeat them or expose them. Junior, I have no money to invest. Okay, we have a young university student who says, I got no money to invest. So we looked at his finances. And we showed him that you can save $5,000 in the first month, approximately $400 per month. He said, no, he can't. No, he could, because if he stopped buying Nike shoes and the latest phone and the latest this and the latest that, he could save $5,000 a month. And if he achieved 20% a year, he would have additional income of $31,000 per year after 10 years of investments. Oh, is this possible? Of course it's possible. Here we put a chart together how he raises every year to save $5,000 a year. And if we put it in mutual funds and we just use an 8% figure, I mean, you're not going to get this in the recent years with mutual funds for sure. He would still have $78,200 at the end of 10 years. But if we showed him how to invest and achieve 20% a year, he would have $156,000. So his return every year after that, if he was able to achieve 20%, he would get an additional $31,000. So he's got a job which pays him, let's say, $60,000, and he will have an additional $31,000 income from investments. That brings him to a $90,000 range. Now, that's something you need to think about. The question people have is, ouch. Let's look at the husband. Let's say the husband has a TFSA and has been working for a while. He's got $50,000 saved in the TFSA. And if he was able to achieve 20% a year, then he would have $120,000 sitting on his tax-free savings account, which would then, at 20%, will generate $20,000 a year. What about the RSP? Let's say the combined RSPs for the husband and the wife, they have 120,000. They would achieve 34,000 a year, giving you a 20,000 plus 34, approximately 50,000 a year additional income. If they were able to live on $50,000 per year, they could effectively retire. But then what do you do? Hell. So let's look at mutual fund performance. What is the average return on mutual funds in Canada? A 2.5% MER, that is fairly average for advisors to recommend in Canada, would give us a 5.5 average annual return. However, only the vast majority of mutual funds do not achieve index-like returns. And mutual funds that are recommended by advisors have even worse results than that. And this is a February 1st, 2021 report. So your fund return was 5.5%. You paid in fees 2.5%. So your net return would be 3%. Looking at the chart below, for June 2021, inflation was at 3.1%. So if you received 3% and you had, and inflation was running 3%, you are at net zero, which means you're losing money. Think about that. All right, let's look at the 2008 stock market crash that everybody talks about. The stock market crash of 2008 was as a result of defaults on consolidated mortgage-backed securities. Subprime lending loans comprised most of MBS. This was a scam started by banks and generated a market crash in 2008. And you can see here the market from the blue dotted line, 14,000, fell to about 8,000 in that time frame. 2008, 2009, 2010, 2011. It returned to 14,000. It had a few hiccups and is now broken. In 2015, it broke through the 14,000, went up to 16,000 and continued to stay above the 14,000 for a while until the COVID challenge. So did you lose all your money? No, you didn't lose your money if you didn't sell it. If you owned Royal Bank, why would you sell it? Well, we'll talk about that later on. All right, what about the COVID 2020 crash? On February the 12th, 2020, it was sitting at almost 18,000. The market was sitting at about 18,000. And by March 23rd, 2020, it fell to 11,200, about 38% or 7,000 points. It just crashed down here. And most people, and these were experts and smart, perceivably smart people, said this is the end. The world ended, according to them. And they even suggested you wear 6 masks, wash your hands with Lysol, bathe in Lysol, kind of thinking. All right, in 15 months, this same market rose to 20,000 points, above 20,000 points. That is 9,000 points or 81% increase. Right? If you held the stock at 18,000, it's now 20,000, you're in the money. So can you make 20% per year? As soon as you suggest 20% a year, what do the average guy say? Nah, it's impossible. I'm looking at my mutual fund report. I'm making 0.25%. And these are the experts. These are the experts. If experts can't make 0.25, they only can make 0.25%, if not even a loss of 6%, how can you? Well, let's look at this. Enbridge. Enbridge, if you don't know what it is, it's an oil pipeline company. across Canada. It is one of the largest pipeline companies in the world. And let's say on November of 2020, you bought this stock at $36.50. So in July of 2021, you sold it at $49.50. So you made $13 profit, or 36% in 8 months. Can you make 20% in a year? It just showed you made 36% on one stock. So how do I know when to buy and when to sell? Here are technical indicators. Technical indicators that we show you how to study and read indicators. These squiggly lines, these blue and red lines, will teach you how. Once you know, it's easy. It's when you don't know that it makes no sense. Okay? 38%, 36%. You're looking at 20%. But I prefer to have the experts. They know better than you. Okay? Best large market capital mutual funds as May of 2020. 1 year ago. RBC European Equity Fund gave you 4% after 5 years. European fund. Okay. Why would you want to go and invest in Europe? Do you know the exchange rate? You don't. 5 years, 4%. All right, let's look at the Canadian dividend fund. Large equity capital. Right, here is $7 billion asset base. First year, negative. After 3 years, still negative. So after 5 years, 1.88%. Do you know what it cost you? 1.76%. It cost you 1.76% to get 1.88% after 5 years. What nonsense is that? What about the US fund? Do you want to pay the exchange rate? Off the bat, you're down 30%. Why? Because the exchange rate is $1.30 Canadian to buy $1 US. Why would you do that? So if you add inflation to your cost of the funds, it will destroy your investments. Check it out for yourself. Let's look at Royal Bank. You know, everybody knows Royal Bank. So in May of 2011, you bought this particular stock at $44. In August of 2021, you sold it for $131. You made approximately 200%. So what are all these green Ds here? These are the dividends that Royal Bank paid. So every time you hold a stock of this company, of the Royal Bank, at the end of each quarter, they will pay you a dividend for every share that you have. So the total for the years were in 2012 was $2.28, and it constantly increased, and 2020 was $4.29. Of course, 2021 is not yet over, so it still has 2 more quarters to be paid up. So let's do a theoretical calculation. So you bought the stock at $44 and you sold it at $131. So you had a gain of $87, or approximately 200% on a share appreciation level. Your dividend income was $32.82 over the time frame that you held the stock. So you had a return on your investment of $119.82. That's amazing. Okay? You put in $44, you got back $119.82. And what was your risk? One of the top biggest banks in Canada. What if you bought 100 shares every January since 2012 or 2011? Every January you decided to buy 100 shares, right? So the buy price in 2012 was $52, so it cost you $5,200, and so on and so on and so forth. So that at the end of the January of 2021, you bought 100 shares at $100 per share. You invested $10,500. He said, that's too much. No, it isn't. You have to save your money in RSPs. You could just buy it in your RSP account or your tax-free savings account. And the shares paid dividends. All these dividends we talked about earlier. So the total amount of dividends that you had was 3,282, and it cost you 82,300 for the 100 shares for the last, 10 years. And you sold the 1,000 shares at 131. You had $131,000 in income on those sale of shares. Your actual gains was 48,000 because you paid 82,000. 1131 minus 82 will give 48.7. And you add the dividends, you have a return of 51,982 or 63%. Why are they saying 20% is hard to get? Who told you that? No way, it cannot be done, they say. They continue to say, on the how much evidence you have provided. Yet, there is a perception that they can't do it. Well, let me show you. This is a TD bank statement or investment statement. What did they do in the last 3 years? 1,000%. Look at here. March 27, 2020 to February, almost 1 year, 2021. That's 12 months, right? The last 12 months he made about 39%. 1,000% in 3 years. 5 years was 852%. The evidence demands a verdict. Can it be done? Absolutely. Why? Because once you learn how to do it, it's fairly easy. And we'll teach you how to do that. Teach a man to fish. The Train to Invest program, reinventing wealth management with a new paradigm. Forget the ancient strategies of buy and hold. Forget about Jetsco, Eaton, Research in Motion, and so on. Here's a novel concept. Take small profits at a shorter intervals. How about taking 1% within 14 days? If you only achieve 1% in 14 days, approximately 30% per year. What does your headspace say to the above statement? Most people will say it cannot be done. Why? The experts couldn't do it, so a novice can't, is the answer. Maybe there is a reason why the experts want you to think that. Remember Freedom 55? Guess what? Your financial planner retired at 55 on the fees you gave him. What is stopping you? Fear. I cannot do it syndrome. When it comes to management of investments, you don't need a PhD in finance or economics to consider taking on this responsibility. The skill set of investing, just like any other skill set we learn, can be successfully attained through education, practice, and ongoing improvement over a period of time. No one expects you to be an expert over a weekend. Train to Invest, which was founded in 2004, is founded on the concept of providing a superior financial and investment education through a student-centered approach. The student's success is our number one priority. Train to Invest doesn't have salespeople. 90% of our revenue comes from referrals by existing clients. 10% comes from, of course, advertisements that we run. What do? We deliver a step-by-step learning process that breaks down complex subject into manageable, bite-sized pieces of information. The teach, train, and coach approach delivers complex issues in bite-sized modules, eliminating information overload. Okay, so we have fundamental analysis, the science of investing, technical analysis, the art of investing, emotional investing, the risk of investing. So once you control your emotions and just go through the mechanics, you should be able to get 1% in 14 days. You can send us an email at admin@TRAIN2INVEST for details. The course itself is about a 6-month time frame. You have phase 1 teaching, phase 2 training, and phase 3 coaching. What is the cost of the program? You say, let's deal with the concept called value. Which one of these cars is worth $75,000? They are both cars that take you from A to B, except when you meet a Mack truck. In which one would you be safer? Now here's what you need to do before you deal with the concept of what does the program cost. First, calculate the cost that you're currently paying per year and then multiply it by 10 times, because that's what it costs you. Second, what if you earned 6% on the cost that you gave away? How much would that amount to? Third, what did you receive for the fee that you paid? So let's discuss the need. You can call us. I want to thank you for listening to us. I really appreciate that your mindset is changed to some extent by what we have heard today. So give us a call and send us an email. We'll take care of any questions and challenges that you may have. Thank you.
Thank you for visiting our channel. If you want to know more about building wealth, please click on the subscribe button. For further details on what we do, please visit www.train2invest.com. Thank you for visiting our channel. If you want to know more about building wealth, please click on the subscribe button. For further details on what we do, please visit www.train2invest.com.